Once you find a great company at a great price, how do you know if its management is confident in itself and will it reward you, its shareholders? So, hello everyone, I am Tamandeep and this is the final video on investment matrices. And in this video, we'll study the ultimate shareholder friendly matrices. So, let's get started. In this video, we'll study why a successful buyback is the quickest way to earn money in share market and how to know if a company's dividend is safe. So let's start with shares buyback. See, if a company is buying back its shares, it's the ultimate and honest move to show that how confident they are in their future. Right. But sir, isn't it too vague? Being confident is good, but confidence does not put food on the table now, does it? Yes, confidence is good, but share buyback is much more than just a confidence move. Let's see how. Now, how many of you remember EPS? We have talked about it quite a few times by now. So, EPS is net income over share outstanding. Now, think about it. See, company is buying back its shares, so the number of outstanding shares decreases. The denominator is decreasing. Yeah. So EPS will increase. Now, if EPS increases, we have here PE ratio. That is current share price over EPS. EPS is increasing. So PE ratio will decrease. It's obvious, right? And if the PE ratio decreases, we expect the price of the share to increase. So is that it? Did we just crack the share market? If things were that simple, then everyone would be millionaire now, wouldn't it? You need to keep account of a few more things. Let's consider them warning. So when a company is buying back its shares, it needs to be at an attractive price, as attractive as a big booty Latina. Yeah, I didn't say anything. So, attractive price is when the price is low. Yeah. Similarly, you need to make sure that a company is not having a new large debt because of the share buyback, right? If they are just taking loans to buy back its share, that's not good. With high debt, there is a high risk. So keep that in mind. Now that I have given you these warnings, always check in the balance sheet of a company, number of outstanding shares. If it's decreasing consistently, you know that the share is good. Now let's move on to the next matrix. Dividends. Dividends. So let's say you have invested in a slow grower. Why would you invest in a slow grower? It hardly beats inflation. Only reason to invest in that is dividends. But is the dividends of that company sustainable? Let's find out. For that, today we will learn a new matrix. We haven't talked about this before. Payout ratio. So what is payout ratio? It's annual dividend per share upon earning per share. So let's talk about this ratio for now and let's keep the dividend out of mind for now. See, let's say the payout ratio is high, which means the annual dividend is high, which sounds good, but it's not actually. See, it means a large amount of its earning is sent to its shareholders. So, for whatever reason, let's say company's earning decreases temporarily though, but it decreases for that annum. The company will not be able to give you the dividend, which means the dividend is not sustainable. It's not safe. Company might or might not give you depending on its situation. But if the payout ratio is low, let's say 10% or something, and the earning decreases, let's say by 20-25%, the company still has surplus money to give you dividends. So you know, even if the market is low, a company with low payout ratio will still give you dividends. At least you expect it to, because it has that money to give you dividends. So low payout ratio is safe and high payout ratio is unsafe. So that is the warning. Low is safe and high is dangerous. So that means never invest in a company just because of its high dividend. Always check the payout ratio. If the payout ratio is high, it does not matter if the dividend is high. When the market will be low, it won't give you any dividend. So there you have it, guys. The conclusion: buyback shows confidence and increases EPS. And if the payout ratio is low, the dividend is safe. So these matrices show that the company is working in best interest of the shareholders. So with this, the investment matrices series comes to an end. We saw if the share is priced right. We saw if the company is financially safe. We saw if the story is sound. And today we saw if the management is shareholder friendly. So that's it for today, guys. If you haven't seen other videos of the series, go see them, and see you later. Bye.